We all want a simple formula to secure our financial future. That's why banks and advisors love handing out rules of thumb, neat one-size-fits-all guidelines to fix your money. But when you actually lay these rules out, the math gets intimidating fast. They tell you to save 30% of your take-home pay, cap your debt at 40%, and sit on a massive pile of cash. Try applying all of that at the exact same time, and you quickly realize it requires a flawless, high-income life where the car never breaks down and the roof never leaks. Today, we are going to stress test the 10 standard rules of financial planning. We must separate the rigid guardrails you can't ignore from the flexible guidelines you can bend. Because trying to blindly follow every piece of financial advice without adjusting for your specific income level usually causes more financial strain than it prevents. This reality check matrix grades the 10 rules on difficulty and financial impact. Top right, 30% savings and 20x retirement demand extreme discipline but guarantee wealth. Bottom right, 12-month cash requires hoarding. Top left, life insurance needs low effort but offers massive protection. Plotting these rules reveals a clear truth. Not all financial advice carries the same urgency, and they certainly don't offer the same return on your investment. This chart examines Rule 2, holding 12 months of cash. The downward line shows inflation eroding purchasing power over 5 years. Now factor in opportunity cost. Invested in the market, that cash generates compounding growth. Holding too much creates massive inflation drag. For most people with stable jobs, holding 3 to 6 months of expenses is plenty. A 12-month buffer should be strictly reserved for freelancers or those in highly volatile careers. That brings us to Rule 3, securing 10 to 15 times your annual income in term life insurance. This ensures absolute financial continuity for your dependents if the worst happens. The trade-off is straightforward. Paying those monthly premiums directly cuts into your current disposable income. Protection rules are essential for disaster prevention, but if you overallocate to cash in the name of safety, you are ironically guaranteeing that you lose money to inflation. Next, we move to the liability bucket, governed by Rule 7. Your total monthly debt payments, your EMIs, should never exceed 40% of your take-home pay. That 40% hard cap prevents you from becoming overly leveraged. If you stretch past that line, a single financial shock, like a medical bill or a pay cut, leaves you highly vulnerable to a default. Rule 5 for vehicles relies on the 20-4-10 structure, 20% down, 4-year term, and payments under 10% of your income. But average modern car payments push past that 10% threshold. To follow this math, most owners must buy used vehicles or delay their purchase. The math gets even stricter with housing. Rule 4 caps your home purchase at 2 to 3 times your family's annual income. This rule exists to ensure you are never house poor. But in high cost of living areas, sticking to this multiplier often dictates renting for an extra decade. Then there is Rule 6, which caps education loans to your expected first-year salary to ensure you can comfortably service the debt upon graduation. Adhering strictly to these 4 liability guardrails protects your future wealth, but it requires sacrificing current-day status and prestige. Finally, we hit the wealth-building rules. This engine is driven by Rule 1, saving 30% of your take-home pay, and Rule 8, which dictates that your equity allocation should equal 100 minus your current age. This chart illustrates Rule 9, the rule of 72. It calculates how fast your investment doubles based on average returns, but achieving this requires emotional stamina. The smooth compounding line gives way to extreme market turbulence, forcing you to weather volatility without panic selling. You ride out that volatility to hit Rule 10, accumulating a retirement corpus equal to 20 times your gross working income. You need a target that large to execute the Bengen rule. By withdrawing no more than 4 to 4.5% of that corpus annually, you can comfortably replace 80% of your working income. These growth rules are mathematically flawless for building wealth, but they demand rigorous delayed gratification and avoiding lifestyle creep. This flowchart maps out how you should actually use this advice. Rules of thumb are compasses, not GPS instructions. Attempting all 10 at once just leads to burnout. If we follow the first branch for beginners or those carrying heavy debt, the instruction is clear. Ignore the 30% savings rule entirely for now. Before you can aggressively invest, you must stop the wealth destruction caused by debt and build a baseline 3-month cash buffer. Following the path for a mid-career earner with a family, the non-negotiables shift to the protection rules. For this demographic, playing defense by capping housing costs and securing life insurance outweighs taking heavy risks to maximize investment yields. But if we map the path for the high-income optimizer, the focus shifts entirely to the growth rules. Once debt is managed and protection is secured, optimizers must push for that 30% savings rate and reverse engineer the math to hit their 20x retirement target. At this level, you can aggressively adjust the 100 minus age equity rule, taking on heavier market exposure if your risk tolerance and emergency buffers allow it. Every financial decision comes down to a trade-off between safety and simplicity on one side, and effort and opportunity cost on the other. Personal finance is deeply personal. Use these 10 rules to identify your single weakest link, fix it, and then bend the math to fit your actual life.